What if I told you that the money sitting in your bank account right now doesn't actually exist? I'm serious. Look at your banking app. See that number? It's not real, and I can prove it. Here's a test. Tomorrow morning, I want you to imagine something. Imagine if everyone in your city woke up and decided to go to their bank and withdraw all their cash. Every single person. What do you think would happen? You'd expect the banks to just hand over the money, right? I mean, it's your money. You deposited it. It should be there. But it's not. The banks would collapse within hours. The ATMs would run dry. The tellers would lock the doors. The system would implode before lunchtime. And this isn't some crazy conspiracy theory. This is exactly how the system is designed to work. Welcome to fractional banking, the greatest magic trick in human history. And once you understand it, you'll never look at money the same way again. Let me take you back in time, way back, before banking apps, before credit cards, before paper money even existed. We're talking medieval Europe, a time when money meant something you could actually hold in your hands: gold, silver, precious metals that had real weight, real value. If you were wealthy back then, you had a chest full of gold coins somewhere in your house. But here's the problem. Gold is heavy, and if you needed to travel or make a big purchase, carrying bags of gold around made you a walking target for thieves. So wealthy people came up with a solution. They started leaving their gold with goldsmiths. Now, goldsmiths were the guys who worked with precious metals. They had workshops with heavy doors and secure vaults because they needed to protect their materials. So it made sense. You'd bring your gold to the goldsmith, he'd lock it up in his vault, and he'd give you a piece of paper, a receipt. This receipt was basically a promise. It said, the bearer of this note can come back anytime and collect their gold. Simple enough, right? But then something interesting happened. People realized they didn't actually need to go back and get their gold every time they wanted to buy something. They could just trade the receipt instead. Think about it. If you wanted to buy a horse, why bother going to the goldsmith, withdrawing your gold, carrying it to the seller, and then having the seller carry it back to the goldsmith? You could just hand over the receipt. The paper represented the gold. It was easier, lighter, safer. And this is where everything changed. The goldsmiths started noticing a pattern. They had hundreds of clients, hundreds of people who deposited gold. But on any given day, maybe 1 or 2 people would actually show up to withdraw. Everyone else, their gold just sat there in the vault, untouched, collecting dust. And that's when the goldsmiths had an idea, a brilliant, devious, world-changing idea. They thought, what if we issue more receipts than we actually have gold? Think about it from their perspective. If you've got 1,000 gold coins in your vault, but you know that 99% of your clients will never come to claim it at the same time, why not issue 2,000 receipts or 3,000? You could lend out those extra receipts to people who need money, charge them interest, and make a fortune. And as long as everyone doesn't show up at once demanding their gold, nobody will ever know. This was money created out of thin air, magic. Except it wasn't magic, it was fraud. But it worked so well that it became the foundation of our entire banking system. Let's pause here because this is important. The moment people accepted paper receipts as being just as good as gold, money stopped being a physical thing. It became a promise, an IOU, and promises can be broken. By the 1600s, this practice had evolved into full-blown banking. Institutions emerged to formalize the trick, and governments loved it. Because if banks could create money out of nothing, governments could borrow that money to fund wars, build empires, and stay in power without raising taxes directly. The Bank of England was founded in 1694 for exactly this reason. England was broke. They'd been fighting expensive wars, and the crown was drowning in debt. So they created a bank, not to serve the people, but to lend money to the government, money the bank didn't actually have. The government would pay it back later, with interest, using taxes collected from ordinary citizens. Sound familiar? It should, because that's exactly what happens today. Governments borrow money that doesn't exist, and you pay it back through taxes. The United States followed the same playbook. Early American banks issued their own banknotes, supposedly backed by gold. But just like the goldsmiths, they issued far more notes than they had gold to cover, and every so often, the illusion would crack. Picture this. A rumor starts spreading that a bank might be in trouble. Maybe they made some bad loans. Maybe people just got nervous. Doesn't matter. Once fear sets in, depositors panic. They rush to the bank to withdraw their money before it's gone. Lines form around the block. People are shouting, pushing, desperate to get their cash. And then the bank runs out. The vault is empty. The money isn't there. The bank collapses. People lose everything. This happened over and over again throughout the 1800s and 1900s. Bank runs were a regular part of life. And every time, it exposed the same ugly truth. The money was never really there. But instead of ending this system, governments did something wild. They doubled down. They created central banks whose entire job was to make sure the illusion never fully collapsed. The Federal Reserve was created in 1913 to be the lender of last resort. If banks got in trouble, the Fed would step in and keep them afloat. The message was clear. Even if the money doesn't exist, we will make sure people keep believing it does. Now let's fast forward to today. Let's talk about how this works in your life, right now with modern banking. You walk into a bank and deposit $100. You check your app and yep, there it is, $100 in your account. You assume that money is sitting in a vault somewhere with your name on it, right? Wrong. The bank takes your $100 and immediately lends out 90 of it to someone else, maybe someone getting a car loan. They keep 10 in reserve, just in case you come asking for some of it back. But that $90, it's gone. It's in someone else's account now. But here's where it gets weird. That person who borrowed $90, they spend it. Maybe they buy a car. The car dealer deposits that $90 into their bank. Now that bank keeps $9 and lends out $81. That $81 gets spent and deposited again. Another bank lends out most of it, and on it goes. By the time this cycle finishes, your original $100 has turned into nearly $1,000 circulating in the economy. But here's the thing. Only that first $10 actually exists as real cash. The rest is all debt. It's all promises to pay. Every new dollar created in the system is someone's obligation to pay it back, with interest. Your $100 just became $1,000 of debt. And if that blew your mind, buckle up, because I haven't even told you the craziest part yet. In the past, banks were required to keep at least 10% of deposits in reserve. That was the rule. But in March of 2020, the Federal Reserve changed the rules. They dropped the reserve requirement to 0. That's not a typo. 0. Banks are no longer required to hold any of your money in reserve. Not 10%, not 1%, nothing. So what's stopping banks from just lending infinite money? Good question. The answer is something called capital requirements. These are rules created by a group of central bankers and financial regulators who meet in Basel, Switzerland. They're called the Basel Accords, and they're decided by people you didn't elect in meetings you'll never attend at a place called the Bank for International Settlements. Some people call it the Central Bank of Central Banks. Here's how it works now. Banks don't lend from deposits anymore. They create loans first. When you get approved for a mortgage, the bank doesn't go into a vault and pull out cash. They just type numbers into a computer and create new money. Your loan creates a deposit. Money appears because you promise to pay it back. After the loan is made, the bank checks to see if they have enough capital to cover the risk. Capital means the bank's own money, shareholder equity, the cushion that protects against losses. If they want to make risky loans, they need to hold more capital. If the loans are safe, like government bonds, they can hold less. But notice what happened here. The money didn't exist before the loan. The loan created the money. That's why more than 90% of all the money in circulation today isn't printed by the government. It's created by banks out of thin air every time someone borrows. Let that sink in. The money in your account isn't the same as a dollar bill. It's bank money.
It's digital. It exists because someone, somewhere, promised to pay it back. And that's why every financial crisis is really a crisis of confidence. Because the moment people stop believing the money is real, the whole thing falls apart. Let me give you 3 consequences of this system that affect your life every single day. First, inflation. Because banks keep multiplying money through loans, there are more and more dollars chasing the same amount of goods. That means prices go up. Your dollar buys less every year. It's not just supply and demand, it's the currency itself being diluted, watered down, losing value. Second, perpetual debt. Since all money is created as a loan, there's always more debt in the system than there is money to pay it off. Think about it. If $100 is created, but you owe $105 because of interest, where does that extra 5 come from? Someone else has to borrow it into existence. The system requires more and more debt just to keep running. There's no finish line. Someone, somewhere, must always be in debt. Third, wealth concentration. Banks collect interest on money they never had. Governments use this system to fund wars and programs without directly raising your taxes. And the wealthy, the people who own real assets like real estate, stocks, and gold, they benefit the most. Because as inflation pushes prices up, their assets become more valuable. Meanwhile, your paycheck buys less and less. You're working harder to stay in the same place. Now let's talk about what happens when the trick fails. Because it does fail, regularly. 1929, the Great Depression. Banks had loaned far beyond their reserves, fueling a stock market bubble. When reality hit and the market crashed, people panicked. They ran to the banks to get their money, but it wasn't there. Thousands of banks collapsed. People lost their life savings overnight. 2008, the housing crisis. Banks had created mountains of debt through mortgage-backed securities. They were lending to people who couldn't afford to pay back. The whole thing was built on the same principle, more promises than reality. When people started defaulting, the entire global financial system nearly imploded. And what did governments do? They bailed out the banks. They pumped trillions of dollars into the system to keep the illusion alive. Because without the trick, the modern economy can't function. They didn't fix the problem, they just kicked the can down the road. Here's something most people don't realize. The system can't afford for you to be debt-free. If everyone paid off their loans tomorrow, the money supply would collapse. There'd be nothing left to circulate. The economy would freeze. You are the fuel. Your debt keeps the machine running, and that's not an accident. It's the design. So what do you do with this information? First, understand that money is not wealth. Real wealth is assets that hold value outside the system. Land, skills, resources, knowledge, things that don't disappear when the banks close their doors. Second, know that debt is a trap. It's not neutral. The system is designed to keep you borrowing, spending, and working to pay back money that never existed in the first place. Third, recognize that inflation isn't random. Every year, your savings lose value. That's the cost of keeping the illusion alive. Does this mean the whole system is going to collapse tomorrow? Not necessarily. But it does mean you need to rethink how you see money. Keeping cash in a savings account won't protect you. Trusting the system blindly won't set you free. The only way to build real financial security is to step outside the cycle. Own things that survive inflation. Invest in yourself. Learn skills that can't be devalued. Build independence. Because here's the truth nobody wants to say out loud. The goldsmiths of medieval Europe, the bank panics of the 1800s, the financial crisis of 2008, they're all the same story. A system built on promises it can't keep, and a public that believes until belief becomes impossible. This story isn't over. Every financial crisis we've lived through is proof that the system's stability doesn't rest on gold or productivity or anything real. It rests on confidence. And confidence is fragile. So the next time you open your banking app and see that number staring back at you, remember this. Most of that money exists only because someone agreed to go into debt. It was created out of nothing, and it can disappear just as quickly. The system was never designed with your freedom in mind. It was designed to keep you playing a game where the house always wins. But now you know the rules, and that changes everything. If this opened your eyes, hit that subscribe button, because history doesn't just repeat, it rhymes. And I'm here to show you the patterns they don't want you to see. The game is rigged, but you don't have to keep playing.